Right, okay. Uh, Very good evening. First of all, I wish you all the best for the new year. Right. Just to refresh from the last session, I will first of all take you through the things that we discussed, and then we will go through the areas which is relevant for today. Starting with business valuation. Now, in the last session, you would have remembered that we discussed this with three questions, right? I said this entire subject we can answer by three questions. One is basically what is business valuation is all about, and why we need to do a business valuation, and how are we going to do a business valuation. So basically, this discuss the first part. The question one, what is business valuation? So basically we are discussing today uh, what business valuation, and then why we need to do business valuation, and finally what are the methods of business valuation. So in the last class we discussed simply what is business valuation means. So what is business valuation means. So when we discuss about what is business valuation, we came up with many definitions, and we had different way of expressing the valuation of business. Right, okay. Okay, sorry for the interruption. Okay, let me quickly discuss what we explained in the previous one. What is business valuation? In the last session, we discussed that business valuation is all about understanding the intrinsic value of the business. So therefore, intrinsic value very simply referred as the core value of a business, right? So in this entire process, or in this topic, what we are trying to do is we are trying to understand the intrinsic value of a business. So this is linked to your assignment as well. So at the end of this particular topic, I will be giving you an assignment. The assignment is where you need to select a company listed in Colombo Stock Exchange, and you need to understand the intrinsic value of this business. That's basically the learning outcome of this particular topic. So in order to do that, first of all, we need to understand what you really mean by business valuation, and then we discussed in the last session how why we need to do a business valuation. So as I also explained, business valuation do not have a one single definition. There are many definitions of business valuation. Some people say it's a art. It's not a science. Why? When you say it's an art, it's very subjective. We discussed that it's like giving a value to a person. Business valuation or giving a value to a business is equal to giving a value to a person. I explained in the last class, if you say for particular, say Mr. X, if you are going to give a value, that value will be differ from person to person, right? Based on so many factors, we are trying to give a value. So therefore, some people will really increase the value of that particular person. Some people will not give a high value for that particular person. So therefore, it is very subjective. In real business valuation also very similar. It's very subjective. So therefore, they call it an art, not than a science. However, we need to learn if you take an example of this particular company, we said, if you are trying to give a value for this firm, there are so many factors we need to consider. We discussed that things like the assets, easily we can start up with identifying the total assets of this organization, the land value, the building value, the machinery and all these items. But then again, there are things that you can't give a value easily, things like the people who are in this organization plays a major role for the success of this firm, but unfortunately we can't give a value. Okay, what is the value of the CEO? What is the value of the managing director? Unfortunately we can't give, but it has an impact to the business. When sometimes the CEO leave the company can collapse, right? Now if you take an example of Japan, when Sony company, when the chairman or the CEO left the company, they lost the market share of the, they were the market leader, they were not being able to continue be as the market leader because of the with the CEO leaving the company. So things like, now if you take an example, companies like Apple, okay, there are the CEO is actually the driving factor of the company success, right? So so Steve Jobs is the main reason for Apple to be at this stage. Or Microsoft, if you look at Bill Gates being the main person, but unfortunately we can't give a value for that person when you are trying to give a value to the business. So therefore it's very subjective. So therefore there are things you can see and give a value, there are things you cannot give a value. So you need to understand the business they are in, the type of industry, and what are the other intangible assets that the firm has. They may have a specific patent, they may have a specific location, they may have a customer database, they may have so much of important information in the organization. Now just to refresh, when the 9/11 attack happened, there were some of the companies, they bankrupt after that event. Not because they lose their assets, they have been rented a particular floor in this building. So if you ask why these companies bankrupt, the main reason was they had the entire customer database, all their information stored in this main office, thinking that there won't be any risk for this particular building. So when the terrorist attack came to this building, they lose all their information, which is one of their biggest assets, but they have not valued it, but they have not kept as a backup. But it has a huge importance. They may have buildings around the country, but that database is very important for their business. So there were so many companies bankrupt because they lose their key information after that event. So there are things which we cannot give a value, but huge important to your value of the firm. So we need to consider all of these factors before giving a value. So we discuss, if it is a software company, the software developers, they have a skill which you can't give a value, but they are the main success factor of the company's value. So all in all, there are so many factors we need to consider when you are trying to give a value. And then we discuss why, the second question, why we need to do business valuation. That is also very important. So first we discuss what is business valuation, then we discuss about why we need to do a business valuation. So what I am trying to do is, I'll be quickly refreshing these things which we discussed in the last session, and then we will do with more calculations on the how we do the business valuation. So these are the main reasons why we need to do a business valuation, starting with when you are going to purchase a business, when you are going to sell a business, when you are going to merge with another organization and acquire another firm, when you are going to restructure a firm, leverage buyouts we discussed in the last session, a management buyout, initial public offer, employee share option schemes, if you are going to buy back some shares or finance a particular project, or we are thinking of a new project implementation, so we are going to take a new loan, and then bankruptcy, valuation due to a court case such as contractual disputes, ownership disputes, divorce cases, intellectual property cases. So all these situations sometimes we need to value a business. And through compliances, suddenly the compliances, the regulation says you need to value all your firms, all your subsidiaries, then we may have to do a valuation, fair value accounting and tax issues, and also for strategic decision making. So all these are the reasons why we need to do a business valuation. So once we do that, we discuss how we are going to do a business valuation. As I explained in the last session, we explained that there are three approaches of valuing a business, right? First, from an asset approach, we look at the asset base of the firm, right? So we understand the total assets of the firm and trying to give a value. We call this net asset value. Net asset value of the firm. And then we discuss through an income approach. In this method, what we do is we consider all the future cash flows of the business and account for a value of the business. So that's what you call the income approach. And then the last method was the market approach. So we discuss in detail about the net asset value approach in the last class and also the income approach. So we will be discussing this with some sums today, and then we will go to market approach as well. So then we will be covering all the three approaches to value a business, and then I will give you the assignment. So in your assignment, as I said, you need to use these three approaches to value the business. So that's your assignment. Right, okay. So starting with asset base. As I told you, asset base is the easiest and the most simplest or the method in valuation. But even though we have all three approaches, there's nothing called perfect approach. That's very important. Even though there are three approaches, we cannot say asset approach is better than income approach or income is better than market. Each method has its own advantages and disadvantages. So you need to be very familiar what are these three approaches and their advantages and disadvantages. So when you are taking a decision, you need to know these pros and cons, because sometimes the asset approach may be the perfect solution of one situation, where the market approach will be better in another situation. So we need to understand the situations and take a decision. So we start with asset approach. We said we are trying to give the net asset value for the business. Net asset value means simply we take the total assets of the business and then we deduct the total liabilities of the business. So we arrive the real assets, net asset value. In other words, this is the shareholders' contribution. If you take an example, we know the accounting equation as total assets equal capital plus liability, right? So if we want to know, so basically, in other words, capital means total assets minus total liabilities, right? So therefore, the C is the net asset value we are calculating, the capital value of the business. So when you are trying to understand this, there are two approaches of assets base. One is the book value basis, where you calculate, where you identify the total assets and the total liabilities in terms of book value. Where can we find the book values? We need to go to the financial statements. Which statements will give you the assets and the liability values? The financial statements. Which statement gives you the, since you have already now learned this, right? Yeah, the balance sheet. So in the balance sheet, we have where we identify the financial position of the organization, where we identify the total assets, total liabilities, and the capital value of the business. So in the balance sheet, it refers the book value, the recorded value, the book value, where We use the historical cost concept and we prepare the accounts based on the book value. So we can calculate the total assets, that is the addition of fixed assets and current assets, where the total liabilities is the short term liabilities and long term liabilities. So we can get it and arrive the net asset value. Also there is something called fair value. What do you mean by fair value? For the total assets we can identify the value that we can sell in the market, more realizable value, the fair value. And for the total liabilities also we can get a fair value for those assets. We can say very simply like a market value, the realizable value, the value that you can sell, right? In that way you can get the total assets and total liabilities, the fair values, and arrive the net asset value on a fair value basis. So two approaches, one is the book value, the other one is the fair value. Book value is the easiest, where you can look at from the balance sheet and arrive. Fair value is you need to do a valuation for all your assets. Okay, now if you take an example, you want a lease. The moment you want a lease, the leasing company will say, okay, bring a valuation report. So you need to go to a valuers. There are registered valuers where we need to take our vehicle and say, okay, give us a valuation report. Right? If you are taking a loan, the bank will say we need a valuation report. So then you need to go to a reputed valuer and then they will give you a valuation report of your land. So like that, you are trying to get a fair value for all your assets and liabilities and arrive the net asset value on a fair value basis. So each method has its own advantages. As I told you, it's easy to understand, easy to access, and especially relevant for tangible asset intensive businesses. What do you mean by that is, if a firm has so much of assets, in such organizations when you are going to value, this would be a better approach. Now what are these tangible asset intensive businesses, or we call this capital intensive businesses? Businesses like manufacturing firms, where you find so much of machinery. Now think about an organization like a cement manufacturing plant, a garment factory, where you find so much of machinery. The value of the business, majority will be represented by the land values, building, factories, machinery. But on the same time, if you look at a small firm like or a software firm, right, where you know that the asset values are not the greatest, the building may be very small, you may have a couple of computers, but the value of the business is very high. Companies like Google to all these Amazon.com, normally the value of the company is very high, but the asset value is very small, because most of their servers are in the cloud, right? They do a lot of online business. They don't have much assets, because the nature of their business is they don't need physical assets, but they have a lot of businesses. So therefore you need to understand, if a firm is capital intensive, net asset approach is more preferable, but on the disadvantages, if it is not a capital intensive business, this is not the best approach. Also we discuss about this minimum value of the firm. Just to refresh, minimum value means if you are going to take over another firm, you need to bid for a value. So when you are bidding, the minimum value is the amount that you need to ask. Now if you take an example, A want to take over B, there should be a price that A should ask from B. So then if the net asset value of B is 200 million, and if you ask 100 million, they will not interest of giving to you. Why? They know in the open market they can sell their total assets, settle their liabilities and get 250 million net assets. So they will never interest of giving you for 100 million. So you need to start bidding from 250, right? You have to start, at least you need to start from 250, otherwise B is not interested of giving the business to you. So that's why we said the minimum value of the firm. I have explained this in the previous session as well. And then Disadvantages, as I told you, if it is fair value, we need to value each and every asset and a liability, which is expensive, and also these are accounting information, so therefore it's subject to manipulations, and also there are a lot of accounting adjustments, there are a lot of intangible assets, so therefore you cannot give a real value of the business by looking at the net asset values. Okay, let's move on to the income approach. We start with Gordon's dividend growth model and the discounted cash flows. Very simply, in the one of the main weakness of asset approach is asset approach does not consider the future of the business. It does not account for the future of the business. But in this approach, we account for the future of the business. How we do that? We account for all the expected future cash flows and convert into today's value. We discount it into today's value and trying to find the present value of the business. So that's why we say we calculate the present value of expected cash flows, right? So we will do a sum on this area, and then I will explain. I have already discussed this, so I'm not going to explain again. Let's do a question on this. Okay. So if you look at this organization, IOC Limited is a company specializing in manufacturing and sale of oil. Company intends to expand their operations through an acquisition of a non-listed competitive firm called Servo in the same industry. As the finance manager, you are required to analyze the below information and advise the board on possible bidding prices. Now what's this all about? There's a company called IOC. They manufacture oil, right? The IOC is there. They manufacture oil. They are going to they intend to acquire another firm called Servo. After business valuation, we will be discussing on mergers and acquisitions in detail. So there we will discuss all these things. But now what we are trying to do is IOC is planning to take over Servo. In order to take over Servo, you need to know what is the value, how much you need to ask to take this firm. For that, the board has this information. You are the finance manager of this company. You have been asked to tell to the board, okay, at what price we should take this firm. That's the question. This is the information that you have. The assets, fixed assets value, the total current assets. Now, what are these information? Is it IOC or Servo? It's Servo's information. So this is the available information that you have. From that information, you are recommending to the board at which price I should take this firm. Right, okay. Fixed assets are there, current assets are there, liabilities are there, PE ratio is there, earnings per share is there, number of shares issued, company growth rate is there, cost of capital is there, dividend payout ratio is there. Okay, so let's first we'll do what is the easiest one, the net asset approach. Right, so let's quickly calculate the net asset value for this firm. Yes, please calculate and tell me the net asset value. We know the equation. We take the total assets of the business. From that we deduct the total liabilities. So we assume all these are book values of the firm. Yes, net asset value. $530. Is it correct? Okay, good. So thank you. Basically what we do is we take the total assets 450 and 180, it's going to be 630 million. From that we deduct the total liabilities, which is 100 million, and arrive 530 million. So as you know, it's 2 minutes job, right? What we need is the balance sheet, take the total assets, take the total liability. So 3 marks for your assignment. You need to go to the company balance sheet, get the total assets, take out the total liabilities, arrive the net asset value. So you know that this is the minimum value that IOC should request from servo. To start the bidding process, at least you need to say, okay, we would like to take over your firm for 530. Otherwise, servo is not interested of selling the business to you, because anyway in the open market they can sell this for 530. So that's the first approach. Now we go to the income approach. Okay, income approach, as I told you, we are trying to understand the future cash flows of this servo and try to give the value. And these are some of the information that you have, right? In this approach we learn there are two methods. One is, I will explain it again in this. The two approaches, either we need to use the dividend growth model or we need to get the cash flows method. So in this question you have not been given any cash flows, future cash flows, but you can use the dividend growth model to calculate the value. So for that you need to remember the that particular equation. So what is the dividend growth model equation? The value of the business, or we call this, or we can say value of a share, the expected value of a share, we call this P0. P means price, 0 means today. So today's price of the firm, you can calculate it by D0 1 plus G. What is that? D0 means dividends per share today. 1 plus G means always the growth rate. So 1 plus G means with the growth rate. So we believe D0 1 plus G is also called as D1. That means dividends per share in 1 year's time, right? So D1 divided by KE minus growth rate. So what the Gordon says is the firm's value can be arrived by using this particular equation. So therefore we can calculate D0 1 plus G divided by KE minus G. So KE means the cost of equity in this firm and the firm's growth rate. So let's apply this information to what we have and arrive the value. So what is the K? Yeah, so try to apply and tell me what is the value of the business based on income approach, dividend growth model, if you have this information. So they have been given earnings per share, but what we want is dividends per share. The growth rate is there, cost of capital is there. So since we have cost of capital based on the information, what we'll do is we will take the KE as cost of capital, because here we need to assume we have only figure that we have in the available information is 20%. So we take that as the KE of the firm. So if that's the case, let's calculate the value of the firm by using the dividend growth model. Yes, we are getting some answers. Let's calculate and see. Yep. Right, okay. So I think the answer is correct. So let's quickly see how we arrive these answers. D0. Have you been given the D0? That means dividends per share. Dividends per share is not there. But you have earnings per share, right? So, and you have something called dividend payout ratio. So I'm sure that you have learned it before. The link with dividends per share and the dividend payout ratio. So how do you do that? Let's calculate that. I'll write it here. Payout ratio is basically DPS divided by EPS. In other words, from the total earnings, how much the company has given as dividends to the shareholders. What is the payout percentage ratio? So here the payout percentage is given 50%. So 0.5 is the payout ratio, and the earnings per share is also given. That is, earnings per share is $4. So therefore, earnings per share is $4. Payout ratio is given, so can't we find the dividends per share today based on that calculation? So with that, so if you do the cross multiplication, dividends per share is going to be $4 into 0.5, that's going to be $2, right? So DPS is $2, right? So let's apply that here. $2 is DPS. The growth rate is given 10%. So 1 plus 0.1, that is 10%, divide by KE is given, cost of capital is 0.2, cost of capital, that is 20%. Again, don't forget to minus the growth rate, that is 0.1. So if you resolve this question, then you will get 2.2 as the numerator, divide by the denominator of 0.1, you will get 22, right? So 22 is the expected share of a one particular share, the share price of a one share. Then we have 70 million shares issued, so 22 multiplied by 70 million, you will get 70 million multiplied by this 22, you will get $1,540 million. Alright. Now, when you are calculating the net asset value, you got the minimum value of 530, and this is the expected value based on future cash flows of the business. Considering the amount of dividend we are paying to the shareholders, considering the growth of the firm, considering the cost of capital of the firm, considering all the future cash flows. We discussed in the last class, this is a mathematical model. It is like an annuity where if we are going to get the dividends forever, and if we discount it in this way, this is the present value of that entire future cash flows. So you know the maximum amount that you should pay. Now sometimes we will learn this in the future. When you are going to take over firm, if you don't know the limit that you are going to take over or the price that you are going to stop bidding, sometimes you will pay an price which is not realistic, or you call this we are overpaying, right? We are paying which is I would say it's a loss at the end. Okay, sometimes when you, some organizations after the acquisition they collapse because you have pay over the amount that it should be paying, uh, a amount which is not really worth, something like that. So therefore, this will help us to understand what is the maximum amount you should pay, right? So you need to start the bidding process at 5:30 and you need to tell to the directors, okay, fine, you negotiate it, but you should not go beyond 1540, okay, because that is the maximum that you are thinking. However, we learn this in the business valuation under income approach. There are problems in this equation. Yes, mathematically we are saying this is the amount you should go as 1540, but it has its own weaknesses. The weaknesses are, here we assume the growth rate is constant. We believe the company every year they grow at 10%, which is unrealistic. On the same time, we believe the cost of capital is 20%. Now, can we tell today that our firm's cost of capital is 20% forever? It's very unrealistic, right? Because we know the interest rates are changing every year, every month, every 6 months. So therefore, when the interest rates are changing, it has a huge impact to your capital. And when you are getting more and more profits, your retained profits will go up and it will impact your cost of capital. So therefore, keep in mind, there are a lot of assumptions. Okay, even though we are giving a price, it is not the perfect price. It has its own weaknesses. This is something that we need to understand. Otherwise, you know only this method, you say this is the right value and you tell to the board, and to see, it's a disaster. So you need to have some practical sense of your understanding of this valuation. So dividends per share, let's say sometimes you will not have profits to pay dividends. Sometimes the growth rate will be minus certain years, and therefore you cannot 100% rely on this value as well, even though it's a one method, right? So basically that's about the two approaches. So we have applied this information and arrived the two bidding prices. So we can conclude it that when you are going to bid, so when you are going to advise the board, your negotiation start from 5:30 and it should, the maximum value should be 1540, your bidding values. However, these are the weaknesses of this approach and these are the weaknesses of asset approach. You need to mention that as well. So I have already presented this in this particular presentation, so you can quickly refer that also. The asset values, how we arrive the asset values. So how do you get the net asset value? And then the dividend growth model. So sometimes when you, dividend, D0 means the dividend what you pay, current amount what you pay. But what we want is D1. So always remember to account for D1 for your calculation. So we already arrived this answer. So we got the dividends per share as 2, and then we apply the question. 22 per share. So the value became as 1540. Fine. Right. So moving on, the next question. Let's quickly calculate. Since we have already know the asset value, we don't need to worry again because it's it's easy to calculate. But what we want is to calculate based on this information the dividend, the value of the business based on the dividend approach or the income approach. So these are the information that you have given. You have given PE ratio. You know what is PE ratio, price earning ratio. Number of shares issued are given. Cost of capital is given, and plus they have given some information. Dividends per share for the last few years. Now we are in 2014. Sorry, we are in 2013. Let's assume we are now in 2013. And this was the latest pay that you made, and we have some information. So how are we going to calculate the value of the firm based on dividend approach? Let's quickly give a try. So these are the available information that you have. So I'll write the equation here again. Now for this you need to know the dividend per share today. So if we are in 2013, D0 is 14. So all of you can easily identify that. But what we want is D1. So for that we need G, the growth rate. Have been given the growth rate? No, I have not given the growth rate. So Similarly, even in your assignments, the growth rate is not given. You need to find it. So how do you calculate the growth rate? For that, you have given some information. You have the dividends per share over the couple of years. And this is again we discussed in the last class. If we have dividends per share over the last few years, based on that information, you can calculate the growth rate. Okay. How do you calculate the growth rate? So for that we have the equation. I'm assuming that you remember the equation. Under dividend growth model, we learn this. Yep. The growth rate. The previous question, when it comes to Pearson PLC, the growth rate can be arrived by using this equation where we take the highest dividends per share over the period, we take the lowest dividends per share over the period, and then we take the root of the number of years. We call this the number of steps, and minus 1. So let's apply the same situation for the question what we did. Yeah. So if you apply this for the information that we have, then what is the highest dividends? We have paid is 14. The lowest dividend what we have paid is over the period is 9. Right? And what is n here? From 2009 to 2013. Right? So we say the n is either number of steps or number of years minus 1. N means number of steps or number of years minus 1. Okay. Because we need to calculate the growth rate. Okay. From 2009 to 2010 is always 1. Right. So from 2009 to 2010 it's 1. From 10 to 2011. Yes, we don't have that, but it's another step. It's another year. That's the basically 2009 to 2010, 2010 to 2011, 2011 to 2012, 2012 to 2013. Right? So number of steps. So 9 to 10 is 1, 2000, I'll put it in this way, 9 to 2010 would be 1, 2011 would be 2, 2012 would be 3, 2013 would be 4. So number of steps would be 4 here. This is very important. Or you can calculate by the number of years, 2009, 2010, 2011, 2012, 2013. That's 5 years. Minus 1 is again 4. Are we clear with this 4? Fine. So once we resolve that, now for this you need to know how do you arrive it. I'm sure you learn how do you calculate this answer from your calculator. Are we clear with that? Right? Okay, fine. So for that you need to 14 divide by 9. That particular answer has to be root 4, and that final answer has to be minus 1. So what is the growth rate, please? Point 1167. So you get the answer as, what's the growth rate? That is before deducting 1? Before deducting 1? After deducting? Okay, 0.117. 1166. Okay. 1167. Okay, so what is the percentage? 0.1167 means the growth rate is, yeah, so we can say 11.7%. The growth rate is 11.7%. So we can use that 11.7% to calculate the so we got 11.7%. KE 20%, that means 0.2. Okay, that will give you P0. Now we can calculate P0 and multiply by the number of shares and arrive the value of the firm using the dividend growth model. Then how much would be the answer? Yes, 100 okay, P0 167. Point 68 per share. So if it is $14 into 1.17 divide by 0.12 minus 0.117, you will get per share price as 187.68, and if you multiply by the number of shares issued, you will get the Present value of the firm. Is it different? Get the same answer. Yeah, multiply by 80 million. What is the value, please? How much? 15,014. That's okay. Right. So basically, we got the value of the firm. So now what we did was we used now in this particular question you have not been given a growth rate. So keep in mind when you are even doing an assignment, you are exploring the information. You will not be given a growth rate. So you need to find the dividend per share over the at least 5 years. Dividends per share over the 5 years. Sometimes the company have not paid dividends certain years, right? So you need to look at a dividends over the 5 years or even 10 years and then calculate the growth rate. And that is the growth rate you are applying for your question. So you need to look at the real data to arrive this growth rate. And on the other hand, we learned that as a main weakness, in case if the growth rate is above the cost of equity, let's assume once we calculate the dividend growth rate, you got an answer of 25%. Is it possible? It's not possible. Can't we have a growth rate, the firm growth rate of 25%? Sometimes yes. The firm may grow at 25%. Some firms grow at 100%. What do you mean by 100%? This year, let's say the asset base is 100 million. Next year, we have double it. Is it possible? It's possible. Some firms, small firms especially, initial stages the growth rate is very high. They grow at 100%, sometimes 200%. Over a year, like let's say you start with 3 people. Next year you are having 6 people. Then what's the growth rate? 100% growth rate. Your value, what you invested is 20 million. By next year you have a value of 40 million. Impossible? Not impossible, it's possible. So sometimes the company's growth rate is very high at the initial stages. If that's the case, can you calculate the dividend growth model? Let's assume in this question KE is 20%. The growth rate is 25%. Then what will happen? Your denominator is going to be a minus figure. So if you get a minus figure, mathematically can you calculate the value of the business? It's going to be a minus. Doesn't make sense. That's a condition in this model. That's a weakness in this model. In case if the growth rate is higher than the cost of equity, you can't apply the terms. Now countries like Japan, normally the interest rates are very low, 1%, 1.5%, 2%. In even US you find 1%, 2% as the interest rates, deposit rates. So let's say cost of equity like 3% or 4%, when the firm is growing at 10%, you can't apply the dividend growth model. You got what I'm trying to tell you. In Sri Lanka, okay, cost of equity may be like 18%, 20%. So therefore, we assume the growth rate is less. But in case if the growth rate is above this figure, then it's impossible to apply for this calculation. This is where, now when you are applying for your assignment, you will have the same issues. Okay, so then you will inquire, how can I do it after that? That is where I'm teaching. In the real world, how are you going to resolve it? That does not mean that the model is wrong and we are trying to say, sorry, the growth rate is higher than the cost of equity, so we can't apply it. No, we are trying to identify alternative growth rates. So you will come across these problems when you are really doing your assignment. So in a firm where the growth rate is above the cost of equity, there are alternative things which I have already discussed in the last class, but I will refresh. Mainly, we need to think about an alternative growth rate which is below the cost of equity. What are these alternative growth rates? Here what I take probably the turnover as the growth rate, sometimes you can take the asset increase as the growth rate. Instead of turnover growth, now we take, okay, this year we got 100 million turnover, next year we got 120 million, so we assume it's a 20% growth. But probably the assets has not been grown at the same percentage. So instead of the revenue growth, now we are taking the asset growth. Maybe less as an alternative growth rate. Or you are going beyond your company. You are looking the industry growth. Let's say your firm is in the banking industry. You take a bank. Let's say you take Chiran Bank, right? Now from the Chiran Bank's growth rate, now you are going to look at the industry bank, the banking industry growth rate. As an industry, how they have been grown, which you can already identify. Okay? Or you can look at, sometimes it can be the sector, it can be the industry, or it can be the proxy firm. What do you mean by proxy firm? If you have a similar company which is in same size and the same nature, you can take your competitors, the proxy company, as the alternative growth rate for your calculation. Or even you can take the country's growth rate, the GDP. Okay, in all the countries we have a GDP growth rate. So we are assuming our company also growing at the the gross domestic production of the country. So you take the GDP growth rate of the country, or probably not for the year but for the quarter, right? So you can we take different alternative figures instead of your sales increase. Okay, so keep in mind, the most important thing is there is no perfect answer. Whatever the figure that you take, you need to justify. This is the way that I have got my growth rate. I have applied, I took the turnover, it didn't work, so I'm taking the, let's say, the asset approach, asset growth, or it's also too high, so I'm not taking that. Now I'm trying to take the GDP of the countries, or the sector, or industry, or like that. You need to justify your growth rate and arrive your answers, instead of saying, sorry, the growth rate is too much, I can't calculate. You will given a certain marks allocated for that method, that's why. So there are a lot of books explaining different alternative growth rates. I want you to refer and read and write. That's why you need to apply for your knowledge. So it's a different growth rates, fine. So this is a practical issue. So here what we do is we basically get the information that the situation is fine, the growth rate is below the cost of equity, so you can arrive an answer, fine. Now let's move on to right, non-constant growth. Now in the previous question, we assume the firm will grow at a constant rate. We calculate the growth rate as 11.67% and we assume the firm will grow at 11.67% forever. But in the real world, it is not there. Now, this is a classic question where we are trying to understand, if a firm has a non-constant growth, how are we going to calculate the dividend growth model valuation, which I have explained in the last class also, but let's do this question to refresh that knowledge. So NPLC has just paid an annual dividend of 15 pence per share, and the next is due in 1 year. For the next 3 years, dividends are expected to grow at 12% per year. After the third year, the dividend will grow at 7% per annum, and the expected return is 16% per annum. What is the business value of the firm by using the dividend valuation model? Okay, so Let's try to do this particular question. So if you really look at it, they have given an annual dividend. They have given the growth rate for the next 3 years, and after that at another rate. And if that's the case, how are we going to calculate the valuation model? So keep in mind, what we are trying to do is we are calculating the present value of future cash flows. So we are going to convert the future dividends first 3 years at 12% and thereafter 7%, and the expected return is 16%. What is the value? Yep. We have got a couple of answers. Is it the same? Okay, let's do this. Fine. Let's do this question. First, we need to calculate the dividends of the cash flows, or in other words, the future cash flows with the first growth rate. What is the first growth rate? We have two growth rates. One is at 12%, then 7%. So we believe in the first 3 years, the firm is grow at a very high rate. That's what we call the supernormal growth rate, and then a constant growth rate. So we can calculate for year 1 what is the expected dividend. For year 2 and year 3 we can calculate separately and discount it individually to arrive the present value of those cash flows only, because they are non-constant growth. So for those 3 years we need to calculate separately and get the present values, and from year 3 onwards it grow at a 7%. So we need to do a separate calculation for that. So how do we do that? So let's calculate for year 1. If you calculate for year 1, so the growth rate is 12%, 15 pence is D0, today's dividends. So we expect in D1 to pay 16.8. Fine. And if you go for the second year, we believe that the growth rate is also in year 2 12%. So therefore it will be increased twice. In other words, it's like inflation. Both the years it will increase at 12%. So therefore we take, if you take the 15 today's one, if it is twice the increase, it's going to be 0.1. Again multiply by 0.12. Twice. This is the same as 0.12 to the power 2. That's why we arrive for the year 3. And if we arrive for the year 3 as well, we will get 21.1. Now these are these 3 cash flows of the projected cash flows, where we can get the present value separately by using the discounted factor. What is the discounted factor for this question? $16. Okay. So this is also called as cost of capital. We also call it as discounted factor, or sometimes we call this rate of return. Sometimes we call interest rate. For that we have one simple formula for this present value calculation. What is that formula? We use this entire calculation is based on this particular formula. Time value of money, I'm sure you have learned it. What is the equation we use? Yeah, future value is equal to present value 1 plus r to the power n. This is the equation we apply for all these questions. So future value is all the expected cash flows, present value is the today's value, r means rate of return, you know, it can be cost of capital, it can be interest rate, n means the number of times, it's not number of years, number of times, right? Fine. So we got the figures. Now we need to convert. Now if you take an example 16.8, this is in year 1, 16.8, this is the future value. What we want is the present value. So if you apply to this equation, future value is 16.8, what we don't know is the present value. 1 plus r is 16%, so we put 16%, and the time is 1 because it's a 1 year here. We take the annual rate, so we take 1 here. So if you take, then we can calculate the present value of these future cash flows, that is only for year 1, what would be that amount? In other words, we can say present value, this is a multiplication, so we can convert to this side and we can get 1.16 to the power 1, you will get the answer. So the present value of that cash flow would be, so once we get these three figures, you can calculate the present value by using this is 1 point to the power 1, this is 1.16 to the power 2, this is 1.16 to the power 3. If you divide like this, what are we going to get? We get the present value of the first 3 years of dividends. We will get the present value of the first 3 years of dividends. How much is that's going to be? For year 1, what would be the answer? How much? 14.48. 14.48. And for year 2, how much? 12.48. For year 3, please. 10.76. Okay, so basically this is the total of the first 3 years dividend, right? Fine. Now we are going to move into the next section, that is, as I told you, first 3 years we have the non-constant dividend. Now we have a constant dividend. This is where we are applying the full equation, right? So for this, now we know that by end of year 3, we are now in year 3, keep in mind, we are now in year 3. So what is D0 for year 3? If D0 is year 3, what would be that value? We already calculate this. 15 pence is today and it's growing at 12%. So by year 3, what would be the dividends per share? It's 21.1 or something, right? We already calculate this. 21.1. Why? 15 pence, if we grow at 12%, by end of year 3, we are paying 21.1. So what we are trying to do is, we are going to calculate from here to onward. So for this is D0, guys. We are calculating from here. It's a separate calculation. So for that, D0 is year 3 figure. So year 3 is 21.1. So we take 21.1 for that. Then what is our growth rate? So we take 21.1. What is our growth rate? Now we have a new growth rate. We are no more 12%. Now we have 7%. Right. So then 1.07. That's our growth rate. That is what? This is the year 4 value. Right. Now KE minus G. KE is already given for you. 16%. The discount factor, the rate of return, that is, and the growth rate now is 0.07. Now when you calculate it, you will get a figure 250.9. What do you mean by this 250.9? We should be able to interpret this figure. That means from third year onwards, if we were to get a dividend with a growth rate of 7%, when you collect or total all the dividends for the future and discount it at this rate, right, the value would be 250 for a one share. Now keep in mind, from year 1, year 2, year 3, we got the figure separately. This is from year 4 to infinity. That is the figure we just arrived. We calculate these three separately. We calculate this figure by using this equation. So this 250 what you arrive is what? Not today's value. Because D0 we took 21.1. So the answer that you get is not the today's value. It's the third year's value. End of third year value. Right? Now if we want to go for today's value, this 250 has to be discounted again at 16%. Are we clear with that? Right? Even though it's a small calculation, it has so many things. Right? So this is discount the sum of the amounts calculated for stage 1 and 2. So we already did the first part. Now we are going to do the second one. So the present value we already calculate for D1 as 14.5. For D2 we calculate as 14, and for D3 we already calculate as 13.5. And the next stage we got 250. Now if we were to calculate the present value of the future value of 250, we discount it again at 16%, and you will arrive a present value of 160.7. Did you get 160.7? So some of you all have already got the answer, which is great. Right? So now what we did was, now you can see this is the first 3 years present value. This is the present value of all the future cash flows after year 3. Okay. Now when you total it, you can get the present value of all the future cash flows. In other words, all the dividends what we are expecting to pay for the future. Now we have arrived 202.7 pence. In other words, the present value of all the future cash flows have been represented and the value of a share is 202.7. So now if you want to value the total firm, what you need to is multiply by the number of shares, you can get the value of the firm. Little bit of a complication. Okay. So are we clear with this logic? This is where when you do not have a constant growth rate, you calculate it separately. But when you have a constant growth rate, you don't need to calculate each time. You can apply to this equation, get the figure. But what you need to remember is, whatever the figure that you will get is again in halfway, not the today's value. So you need to, based on the year that you get, you need to convert into present value and arrive the value of the firm. So that you need to multiply by the number of shares, you will get the value of the firm. So that's how you get 202.7 pence per share. Okay. This will not apply for your particular assignment, but for your questions, this will be, you need to refer them and understand how you calculate it. Always be careful, 250 is not the present value, it's again a future value. You need to reconvert into today's value. Right, okay. So we'll take a quick break and then we will continue with more sums and then we will go for the market approach. Okay. Right, okay. So in the previous question we discussed about the dividend growth model calculation, and we also said that there are some weaknesses in this approach. Some of the main weaknesses are how to calculate the growth rate of the firm, because as I told you, sometimes it's not easy to calculate the growth rate because the definition of growth rate, it can be the asset growth, it can be the revenue growth, it can be the employee growth, the sector growth, like that. We have different growth rates. So we need to exactly know what growth rate that we need to use. It's a question. It's a debatable question. And also, as you know, some companies do not pay dividends. As a policy, they don't pay dividends. Especially if it is a company which is a family-oriented business. The nature is, in the first few years they do not pay dividends simply because they want to reinvest their dividend and expand their operation. So because they have the understanding with each other, they do not pay dividends in the first few years. So if that happens, then there's no need of where we can't apply the dividend growth model for such situations. So that also has to be and also we discussed that if the cost of equity is lower than the growth rate, then again this model cannot be applied, which we already discussed. If you see this example, in a situation where if the growth rate is like 8% and the cost of equity is like 6% or something, then it's going to be a negative figure, so you cannot apply for this question. And if you, the other situation is the KE, it's a very sensitive assumption that it will be always remain same, because we know that the capital structure is always changing in an organization, so the cost of equity also will change accordingly. So these are some of the main weaknesses of this model. So therefore the importance of this model is questionable. Right, let's move on. Okay, we already discussed this, where if the growth rate is above the KE, what kind of different alternatives that we need to take. Right, so let's move on to the next model, that is the discounted cash flow model. We already discussed this in the last session, so I'm not going to go into detail, but just to refresh, uh, this is where we calculate the expected cash flows. Now in the previous one we take the expected dividends, but we know that some of the weaknesses is some companies do not pay dividends, so it's not fair to take only dividends. So therefore what we take is the cash flows instead of that. So here we discussed this in the last session again. We take the from the accounting profits, we convert the cash flows into we convert the accounting profit into cash flows, and then you use the cash flows to calculate the present value of the firm. So these are some of the adjustments we did. That is, if we have any non-cash deductions, we add back. If you have spent any capital expenditures, we deduct. If you have any working capital adjustments, we do it. It will be a plus or a minus. If we have paid taxes, we have to adjust that, and also again we have to adjust the interest, and finally we should be able to get the cash flows of the future firm. Now this is an example that we are trying to calculate the value of the firm. So we have been given cash flows, we have been given the accounting profit, basically the pre-tax pre-interest profit from 2005 to 2009, and then we've been given cash flows 14 million from 2010 to infinity. Right. So what we do is, first we adjust the non-cash flow items which they have given to you. I'm just taking you through the answers. So they have given some non-cash items, 1 million in 2005, then 2.5 2006, like that. We have adjusted the non-cash items. What are the non-cash items we discuss? Examples like depreciation. We have already deducted in the accounting profit, so we are going to add back. It can be depreciation, it can be loss on like a disposal or something where we have already deducted, so we are going to add back, and it can be any accounting adjustment where we have deducted. Working capital adjustment. Now this is a very important one. What do you really mean by working capital adjustment? Now as you can see, in 2005 it's a positive figure, 2006 it has been a negative figure, 2007 there's no adjustment at all. How is that possible? Working capital, as you know, basically the impact due to the movements of the organization of your current liabilities and current assets. So working capital is always movements of current assets and current liabilities. So let's take an example how this positive or negative will arrive. I'll give you an example like this. We'll take stocks. Now at the beginning of the year you have 100 million stocks. Let's say in your balance sheet at the beginning of the year you had 100 million. Let's say 2015 December you had 100 million. 2016 December you have 150 million. So basically this is your opening balance, this is your closing balance, right? If you had 100 million at the beginning and if you have 150 million at the end, what do you mean by in terms of cash? The stock value has gone up, which means we have purchased more stocks. That's the assumption. We look at always from a cash perspective, what would have happened to this value? Stocks we had 100 million at the beginning, it has converted to 150 million, which means we would have purchased 50 million. That's where the value has gone up, which means what will be the impact to the cash flows? Cash flows has gone down by 50 million. That's the assumption that we take. So we'll take another example. Accounts receivable. At the beginning of the year you have 100 million, end of the year it has gone down to 70 million. What do you mean by that? Accounts receivable, the money, the debtors, the money we are supposed to receive. At the beginning you have 100 million, by the end of the year it was 70 million, which means, in other words, we have received the money. That's why the value has gone from 100 to 70, because we have collected the money. So our cash has gone up. So then if that's the case, it's going to be positive because we are going to add back. But here the value has gone up, as a result we assume the cash has gone down. So here it's a negative figure, right? So this is where we will get situations like pluses and minuses. So if the current assets increased, the working capital has to be a minus figure. If the current assets has reduced, that means the working capital has been a positive impact. But the current liability would be the opposite of that, right? So if you take an example, the same question of this, let's assume now instead of stocks we have current liabilities, where let's say the accounts payable is 50 million at the beginning, and at the end of the year it has become 80 million. What do you mean by that? Just think about it. 50 million has gone up to 80 million by the end of the year. Accounts payables, that means we would have purchased more stocks. That's why it has gone to 80 million. In other words, we would have earned more cash. Why? Because we have not yet paid. That's why the value has gone up. So in other words, the cash impact is a positive impact. So this is where it's totally opposite of the current assets. So this is where if the current liability is increased, that means it's a positive impact to the cash flows. In that way, we find the working capital adjustments to plus or minus to 0. So 0 means it may be nullifying with all the current liability movements to current asset movements. Fine. So then we deduct all the taxes. There's no choice because anyway we have the pre-tax figure. So once we know the amount we pay, we just deduct the taxes from your accounting profit, and then we calculate the interest, because here also we get the pre-tax pre-interest profit. So we deduct the interest and arrive the accounting profit. Finally, as you know, in the accounting profit we do not deduct the capital expenses. We only account for revenue expenses. Therefore, we deduct the capital expenses because we want to know the cash flows of your business. Okay, this is normally when it comes to in accounting, when you are calculating the cash flow statement, we call this indirect method. In the indirect method also, we convert all the accounting profit to cash flows by using the similar approach. When you are preparing cash flow, there are two methods. One is direct method and indirect method, which you have already learned in accounting. So in the indirect method, what we do is we first get the accounting profit and convert the cash flows. The similar approach we do it here, but our objective is not to prepare the cash flow statement, but to arrive the cash flows for the future and then discount it and arrive the present value of the future cash flows. That's our objective. So like that we have calculated all 5 years of cash flows, but they said from 2010 onwards you will have a fixed cash flow of 14 million. Now let's account this the next one. Sorry. Right, now as you can see, we have got the cash flows from the previous calculation, and now we have discounted. Why? Our discount factor was 14%. So we have discounted at 14%. If you can see in year 1 we got a positive figure, but in year 2 we got a negative one. Because we are not telling that always we will get positive cash flow. Some years you may get negative. So if that's the case, your present value also will be a negative figure, right? So we will get all the cash flows discounted by using the 14% and get the present. Now these are the present values: 7.2, 3.5, 10.1, 8.5. These are the present value. But this is the first 5 years. The most important thing is this. We know from 2010 onwards, we learned that they say that from 2010 onwards, the value is 14 million, and that is at infinity figure. So what we do is 14 we have divided by, we treated this as an annuity. We treated this as an annuity and we divide 14 by 0.14, that is the discount factor, and we have arrived a particular figure, and that is in year 5. Like we did the previous calculation, the answer that we get, it's not the today's value, but this is the year 5 value. So we need to convert into today's value, but by discounting again at 1 divided by 1.14 to the power 5. Why? Like we did the previous calculation. In the previous calculation, of course, we had a growth rate. Now here we don't have a growth rate. We assume a 14 million fixed cash flow forever. So what we did was, there's no growth rate, so G is 0 here. So therefore it's 14, the denominator and the numerator both are without growth rate. So 14 divided by 0.14, whatever that figure, we convert into today's value by getting the discount factor for the 5 year, and then we have arrived 51.9. Then what we do is we add all the present values and arrive 81.3 pence as at today. So that is the share price of that for all the future cash flows. So this is very similar to dividend growth model. Only difference is here we take the cash flows. In the previous one we take the dividends. Right? Fine. That's basically the cash flow approach. Right. Now these are some of the information for your knowledge. How to arrive this, the same thing what we discussed, I have shown it as an equation. And the discount rate, right. Now we know if the growth rate is not there, how to calculate the growth rate by using the dividend per share. But sometimes the cost of equity will also not be given. Now for your assignment also, cost of equity not be given. So you need to calculate that. So how do you do that? I'm sure you have learned it from other topics as well. I will just refresh that, because that also used for your assignment, because that's one of your main calculation. Without the cost of equity, you cannot calculate the equation. So the growth rate, you know how to arrive. Dividends per share, you know how to arrive. But what we need, the remaining figure, is the cost of equity. So here the assumption we take is, we take all the cash flows and there's no debt. But in case if the company has debt, we have learned something called weighted average cost of capital, where we account for all the source of finance in the organization and use that weighted average cost of capital to discount your calculation. So let's quickly do what is discount rate. Right. So in other words, cost of capital is the rate of return of the firm, and if you have more than equity, in other words if you have debt and preference shares, then we need to have a combined cost of capital for our calculation. So how do you calculate the weighted average cost of capital? I'm sure you have done this calculation, weighted average cost of capital. We take the cost of equity, get the weightage separately, cost of debt, get the weightage, cost of preference shares, get the weightage, and calculate the weighted average cost of capital. So in other words, we can apply this particular equation and arrive the answer, which we will do it with a calculation in the next few minutes. Right, so let's quickly look at this particular question. So what we need to is to calculate the weighted average cost of capital. Quickly do that. The corporation is to be established by obtaining where one half of its £1,000 million of capital from lenders who requires an 8% rate of return of investment, and the other half they request 12% rate of return. So two sources of finance, one is through debt, one is through equity. Cost of equity is given, cost of debt is given. What would be the weighted average cost of capital in this question? Okay, 10%. Right, so basically this already you have done it, so I will quickly go through it, where you can see 50% is contributed by debt, so the weightage is 0.5 and the equity is again 0.5. So we have taken the cost of equity with the weightage, we have taken the cost of debt with the weightage, and we have arrived the weighted average cost of capital of the firm as 10%. But if you have preference shares, then you need to account for that as well. So this is how, so when you are selecting your company, you need to find the total equity and the total debt and the cost of equity, cost of debt, and then find the weighted average cost of capital, and that is the figure that you are using to the dividend growth model to calculate the value of the firm. That's how it's going to be linked, right? Right, okay, so how do we calculate the cost of equity? As you know, cost of equity can be calculated by two ways. I'm sure you have learned this before. Just to refresh, cost of equity can be calculated by two approaches. One is already given, that is capital asset pricing model. What is the other approach? Cost of equity can be calculated by two ways. So you can apply either of these ways to calculate the cost of equity for your firm. Yeah, what is the one is the capital asset pricing model, the other one is the dividend growth model. Okay, let's do the cost in the CAPM model first. So what is the capital asset pricing model equation? Okay, I'm sure you have learned this very well. Yep, risk-free rate, market rate, and then the beta factor. So basically the risk-free, the cost of equity can be calculated by the risk-free rate, and for that we add the market rate of return minus the risk-free rate into beta factor. You can calculate the KE of the firm. So what is risk-free rate? Yeah, we can easily say treasury bill rate, but it's very simply the rate where there's no risk for your investment. We believe the treasury bill is the risk-free rate. Even though theoretically we say in all economics theories we say the treasury bills are risk-free, today treasury bills also has a risk, right? Why? If the government collapse, then you don't have a return for your treasury bills. Theoretically it's impossible. Why the theoretically risk-free rate is, I mean they say what is the logic behind it? Why they say the treasury bills have no risk at all? Any particular reason? They say the treasury bill has no risk at all. People will get a guaranteed return. Why theoretically they say this? Any particular reason? Yep. Have you thought about it? Or the book says treasury bill rate is risk-free, so I'll take it as it is. Now the simple reason, the theoretical argument is, see, they say the government, there's no risk of investing in the government. The simple logic is, because if the government do not have money, they can print. If the government do not have money, they can always print, which means you have a guaranteed return. Why? If you don't have money, then you can print, then there's no problem, right? So you and I also can print money, then there are consequences, but the government can print money, so there's no issue. So therefore theoretically the economics says there's no risk for the treasury bills. But that does not mean that the government can print what they want and as they wish. If they start printing at bulk amounts, then it will have a impact for their entire economy, which happened in the past also, where countries like Bolivia, they started printing money like that, and the inflation rate increased to more than 1000%, and finally they are at a recession and they basically bankrupt. So it can be such situations if they start printing. In Bolivia, they say at that time the third largest import was bringing paper to the country to print money. The third largest import was bringing paper to print money. So I assume that it will never happen to our countries, but theoretically we say it's no risk, but practically the governments can fail, like in what happened to Greece, to Cyprus, to in the past we have seen where the governments collapse, and if that's the case, risk-free is not a risk-free rate at all. Fine. Anyway, so let's move on what we were talking. So this is the equation that you have already learned. The beta factor is also important. Now you need to apply this again for your assignment. When you select a company, risk-free rate you can identify from the treasury bill rate from the government, which will be published every month by the central bank website. You can get the risk-free rate and the beta factor. Beta factor also you have to calculate for your assignment. But luckily what you can do is, this is already calculated for you. Every company that you selected in the Colombo Stock Exchange, the beta factor is already calculated. So you can, I will upload that list to you. So you need to pick your company that you choose, take the beta factor from my list and apply for your calculation. Beta factor is anyway, this is published by many stockbrokers and CSE, Colombo Stock Exchange. So if you want to type the beta factors of your company, you can get it from the Google as well. So you have to apply all the theories for your practice. That's what is needed, right? Because otherwise there's no point on just remembering these equations. You need to apply and see whether you can calculate the cost of equity for your firm, right? So you will do it. The other model that I was referring is, so either you can use the CAPM model or you can use the dividend growth model to calculate cost of equity. So any firm, you can use either these two models to arrive the KE. So how do you calculate the dividend growth model, the dividend valuation or dividend growth model? Now we have already learned this equation, if you can remember. Already we have learned this equation. In this equation, D0 1 plus G divided by KE minus G. That is what? Price of the firm or price of the share. But here in all your questions, KE was given, right? But in my assignment, I will not give you KE. So you need to write the KE. So what we are trying to do is, we take the KE as the thing that we are trying to find, and we can further develop this in this way. Here, KE can be calculated D1 divided by P0, and we take the growth rate. Okay. Now you know how to get the growth rate. You know how to get the dividends per share in 1 year's time. P0 also you know how to get it. Today's price, current price. If that's the case, you can arrive the cost of equity of the firm. Okay. So two models, either using CAPM model or using the dividend growth model. So either way you have to calculate the cost of equity of the firm. And if your firm has more than equity, which you can find from the balance sheet, it is not fair to use the cost of equity value to value the business. So therefore you need to extend to find the cost of debt and also cost of preference shares. So let's move on to the next one, to arrive the cost of debt. So how do you calculate the cost of debt? Yeah, quickly write that equation also. We need to get the gross interest of the business, and there's something called tax impact from this for that interest. So therefore if you get the gross interest, you take 1 minus T, that is the corporate tax rate, divide by the value of the debt, you will find the cost of, you call this KD, cost of debt can be arrived, get the gross interest, 1 minus T, so that you will get the post tax interest, right? I assume you have done this before. Divide by value of the debt, you will arrive the cost of the debt. And how do you calculate the cost of preference shares? We call this KP. How do you calculate the cost of preference shares? Yeah, what is the cost for preference shares? Cost means in return, when you issue preference shares, in return what we should give, that is the cost for the business. Yeah, if the company issue preference shares, we have to give fixed dividend for them every year. The preference shares, the difference from ordinary shares is you have a fixed dividend. So always if you've been given a fixed dividend, fixed dividend, if you divide by the value of the preference shares, you can calculate the cost of preference shares. In other words, that's the fixed dividend. If the fixed dividend, they say, normally we can find it if you go to the balance sheet under share capital, in front of preference shares they will say 8% preference shares. So that's the cost of preference shares, it's already given. Sometimes cost of debt may not be given, so you may have to get the interest from the income statement. Value of the debt you can arrive from the balance sheet and find the cost of debt. Sometimes in the annual reports, it's specifically given that we have taken this loan for this interest rate. So you can apply it for your calculation if that's the case. Or else we need to calculate that as well. Right, so with all that knowledge, let's quickly do this question so that we have applied all this. I quickly read out. For the year ended 31st December 2009, the following summarized financial information of CIC Limited was revealed by the books of accounts. They have given the annual free cash flows. Annual free cash flows are given. Number of shares issued, risk-free rate is there, current market price is there, interest paid, corporate tax rate is there, value of debt 400 million, value of preference shares 400 million, dividends paid preference shares 60 million, market premium is also given. What is market premium? If you can remember, market rate minus risk-free rate, this is the market premium. Market rate minus risk-free rate is the market premium, right? In another word, you call this market premium, the extra amount that you are paying for this particular security, market premium. And that's already given. I have given the number, that is market rate minus risk-free rate is 12%. Beta factor, all of you know what is beta factor, so this is also 0.9. If that's the case, let's calculate cost of equity, cost of debt, cost of preference shares. Then you calculate the weighted average cost of capital and use the weighted average cost of capital to find the value of the firm. So let's start with cost of equity. Yes, to calculate cost of equity, we have two models, either KE using CAPM model or dividend growth model. So let's start with dividend growth model. See whether we have all the relevant information. We know the dividend growth model, what we need is KE D1 divided by P0 plus growth rate. Okay, fine. So D1 is dividend in 1 year's time. Do we have dividends in 1 year's time or dividends per share? That is preference shares. But we want cost of equity. So cost of equity, we need to find the dividends for ordinary shares, right? But we have dividends only preference shares. We have to be careful. You have to take only, if it is dividends, it should be equity or ordinary shares. So we don't have ordinary dividends here. So therefore, can we apply that model? You can't. Okay. So we cannot apply the dividend growth model for this particular question because we have the price, we have the growth rate, but we don't have the dividend. So let's calculate the CAPM model to arrive the answer. So we have the risk-free rate, and the risk-free rate is 10%, and the market rate, so the market premium is there, that is 12%. So we don't need to again calculate it because 12% is already given for you, right? That is market rate minus risk-free rate, right? So we have the beta factor, that is 0.9. So you multiply it by 0.9, 12%. Whatever the particular answer, you add to the 10%. What is the cost of equity then? K is 11.8%. Fine. So 11.8% we calculate cost of equity. Fine. Okay. Fine. So K is 11.8. So let's calculate cost of debt now. So we have the gross interest, we have the corporate tax rate, we have the value of the debt. Can we calculate the value of debt, the cost of debt as well? Yeah. How much? Okay. So 40 million, 50 million, we have the corporate tax. So it's going to be 40 million, right? Because we have a tax, we have a tax of 20%, right? So 50 multiplied by 1 minus t, that is 0.12. So that means 40 million, divide by 400 million, because we have a debt of 400 million. So 40 divide by 400 million, we will have 10%, right? So that is cost of debt. So we have calculated the cost of debt. Let's quickly calculate the cost of preference shares also. Cost of equity, they say should be added. Yeah. So without adding the 10%. So yeah, the cost of equity has to be cost of equity has to be 20.8%. So thank you for the correction. So cost of equity is 20 point. If you resolve this, you will get 20.8%. And if you say cost of debt 10%, should be 10%. Cost of preference shares, again fixed dividend is given. Dividends of preference share is 60 million. So you divide by the value of the preference shares is given 400 million. So therefore it's going to be 15%, right? Are we clear? So we have got the cost of equity 20.8, cost of debt 10%, cost of preference shares 15%. And what about the values? Now we need, for the equation, we need the values as well. So therefore we have for a 1 share market price, this is the dividends, the market price is market price is $10 for a 1 ordinary share, and we have issued 300 million shares, right? So if we have issued 300 million shares, the value would be 3000 million, right? So weighted average is already calculated. Let's quickly do that. If you apply to this question, we have calculated the cost of equity, we have calculated the cost of debt, we have calculated the cost of preference shares. The weightage is, for you to calculate the weightage, you need to know the cost of value of the equity. Value of the equity is 3000, because 1 share is $10 and we have issued 300 million shares, and value of debt is 400 million. We already got that information. Value of preference shares also 400 million, right? So value of equity would be 3000. So the weight, you can calculate the weightage here. Value of debt would be, total is 3800. From that, value of debt would be 400, and the preference shares also the same weightage, but the percentages are different. So if you calculate the weightages separately and apply to 20.8, multiply by the weightage, and then add to cost of debt of 10% into the weightage, and the cost of preference shares of 15% to the weightage, you will calculate the weighted average cost of capital as Is it 19.05? Here the cost of debt is the post-tax cost. Right? 19.05. Okay, fine. So now we got the cost of capital. Now we have not still finished our question. We have been doing all the homework part. Now we are trying to give the value to the business. Okay, so let's see. In this particular question, we calculate the weighted average as 19.05. Now, how are we going to get the value for the business from this? We have calculated the overall cost of capital of the firm. In order to get the value, if you can remember, even when we are doing the dividend growth model, we learned that if you have a free cash flows or this dividend for the future, we take the annuity formula. What we did was we take the free cash flows or fixed dividend or annual here the cash flow is given 30 million and we divided by what? The cost of capital, right? Fixed dividend. Now, if you take the example dividend growth model, the equation is we take the dividend and we divide by the cost of equity. If we have a growth rate, this will be extended to KE minus G. Here D1 also will change. But the same thing, this is the annuity equation. If we apply the same thing for this question, now dividends, instead of dividends we have free cash flows. Instead of KE we have the cost of capital of the firm. So 30 million if you divide by 0.1905, you can calculate the value of the firm with this formula, annuity. Yeah, free cash flows divided by the weighted average cost of capital. And that will give you the business value of the firm based on this information. So the value of the firm would be how much? 157.46, right? So 157, we will get 157.46 million. Okay. Now again, just recap what I did. Because when you are going to give a value, you need to do a similar approach. You need to find your organization whether they have shares. If they have shares, okay, you can find the total number of shares. You can calculate the cost of equity based on that. For that you have two approaches, either dividend growth model or the capital asset pricing model. Find the KE, then find the interest amount, find the value of the debt, calculate the value, the cost of debt. Then if they have issued preference shares, find the preference shares, find the preference dividends, find the cost of preference shares. Based on that, calculate the weighted average cost of capital, and then you can arrive the value of the firm by using the free cash flows, or instead of, you can even use the dividends, the fixed dividend It's an assumption. We assume that the same dividend will be paid for the future. With that assumption, we can calculate the value of the firm by using the income approach. Right. Now, so far what we have done is, we have done the dividend approach and the asset approach to value the firm. Okay. So we have discussed the advantages and disadvantages also and arrived the values accordingly. So as we discussed the main disadvantages, future projections are controversial, and discount rate is sometimes is not really appropriate or it's not correct, and it may be difficult for an audience who does not have a financial background. So I think we need to do the market approach on the next session. So keep in mind that before next session I will share you the present assignment as well, so you can start working on it. You can select the company and work on these approaches. So far we have done the asset and the income approach. In the next class we will be doing the market approach, and then you can apply all three approaches to give the value for the firm. So if you have any questions, you can email it to me. My email address is there at the beginning of the presentation. Right. Okay, thank you.